On Tuesday, the 2nd of May 2023, the Reserve Bank of Australia announced another 0.25% increase in the cash rate, bringing the cash rate up to 3.85%. This announcement caused the media frenzy and many real estate investors worry about the future of the market. However, is there an opportunity to be exploited here? Have we all been focusing on the wrong side of the event? Does the interest rate play that big of a role in driving the property market? Should we stop investing when interest rates are increasing? And what is the impact of the global economic recession here has on the Australian property market? Welcome back to Real Money. I'm Khurram Shehzad, and let's get started. Personally, if you ask me, I would definitely 100% buy, invest when interest rates are increasing and inflation remains high. The higher the interest rate, the better the investment properties become as an option to grow your wealth. But how? The answers are simple. Property investment offers edge against inflation. Inflation decreases the purchasing power of the money over the time. However, real estate investments have historically been reliable protection against inflation. Inflation pushes the construction cost up. In the last year, almost 12%. So the fact that the cost of building new properties is higher typically slows down the construction industry, resulting not enough new homes being built over time. It disrupts the balance between supply and demand and eventually pushes the value of the existing home higher. Now, property offers cash flow from rental income. Higher the interest rate often lead to increased rental demand. Not many people want to buy. As the cost of borrowing rises, some individuals may choose to delay home ownership and opt to renting instead. That increases the rental and which provides steady stream of income that can help the impact of higher interest rate to the people who take action and own the property. Property investment offers appreciation potential. When interest rates rise, it becomes more expensive for the buyers to finance their home purchase. This can lead to a slowdown in the housing market, resulting in a decrease in demand and potentially impacting property prices, which is what I've witnessed in the property market last year. However, for real estate investors, this can present an opportunity to acquire properties at a lower cost. As the economy stabilizes and interest rates eventually decrease or come to a normal level, property values have the potential to appreciate, allowing investors to build substantial wealth over the long term in terms of capital growth. Look at this property. Bought in 2008, cash rate was at 7.25% for $392,000, sold in November 2014 for $647,000, 65% increase in value in only 6 years. And there are many examples like this. By the way, this was my personal properties example. Property investment offers leverage advantages. Higher interest rates can make borrowing more expensive, but they also enhance the advantages of leveraging in the real estate investing. Investors can take advantage of the lower priced properties and secure financing comparatively lower rates than the prevailing interest rates. This allows them to use debt to invest income generating assets, amplifying their returns and wealth building potential. This graph shows the median house prices in Australia in last 30 years. There are multiple peaks and troughs, and the graph continues upwards in the last 30 years. Would be nice if we bought many properties as possible 30 years ago. Property investment offers diversification and stability. Real estate offers diversification benefits within the investment portfolio. As interest rates rise, other asset classes such as bonds and stocks may experience volatility as well and reduce returns. In contrast, real estate investments tend to be less influenced by short-term market fluctuations and can provide stability during periods of uncertainty. Does interest rate play that big of a role driving the property market? The answer is yes and a no. It may reduce mortgage affordability, reduce buyers' purchasing power, which potentially deters some people from entering the market. It may also impact investors' sentiment, reduce demand from investors. However, all of these are temporary. If we refer to the median house price growth in Australia, property markets have increased 540% over the last 42 years. That is an average growth of 7.62%. So, what do we need to look for? What strategies real estate investors should focus on when investing during inflationary times? How do we protect our investments during interest rate rise? Number one, location will always be the high demand even during times of uncertainty. Investors should focus on buying properties, well-established neighborhoods, near businesses, schools, and healthcare facilities. Look at the location with excellent public transport or convenient access to major roads. Number 2. Consider your long-term investment aspirations. Take your investment objectives into consideration with the various type of properties on offer. If you're looking to invest in commercial properties, focus on areas with high levels of development that may attract greater value in the future. Number 3, generating significant cash flow allows investors to cover mortgage repayments comfortably and expenses associated with the property being part of it. Therefore, secure a low-interest mortgage when interest rates are low will enable investors to have enough margin resulting in healthy cash flow. Number 4, come up with the risk management plan. There is always risk involved in any investments. The real estate markets fluctuate and investors should prepare to unforeseen circumstances. My personal tips. Understand your personal financial circumstances. Test your limit risks. What is your tolerance level? Always leave enough equity in your property so if you are forced to sell, you are not out of pocket. Have a buffer in your serviceability always. Look at reducing your expenses. Put aside 3 to 6 months worth of expenses aside so you can afford to hold and ride the market downturn out. Look at doing extra side hustles to maximize your earning capacity. If you have the funds to invest, this is the time to invest. However, have your agents as your best friends so you get an insight and instant alert on good opportunities. Lastly, it's worth to note that the current interest rate hike isn't the highest ever historical cash rate. Cash rate was at 14% back in August of 1990. Whilst this might feel concerning, the market has its cycles and always recovers. As a reminder, every future property investor should look towards property investment as a long-term strategy that takes time to mature, grows consistently, and becomes more profitable over time. Focus on holding sought-after property. We hope you've learned something valuable from our video today. Taking an action and taking a step forward results into greatness. Not taking any action doesn't result into any returns. Keep watching, keep dreaming, and this is Khurram Shehzad. Thank you very much.